Hey folks, welcome back to Warsh Capital and to this week's Market Analysis Explainer. This detail covers the week of June 1st to June 7th, 2026. This week's report is largely defined by a single number. On Friday morning, the Bureau of Labour Statistics reported 172,000 jobs added in May against a consensus expectation of 85,000. Prior month revisions added another 93,000 to March and April combined. That's not a modest beat. It's a wholesale repricing event for rate expectations, and markets moved exactly as the framework would predict. 6 parts to this video again this week. The jobs shock, markets in review, Bitcoin's 4-year cycle and what the narrative pattern around it tells us, the Iran signal from the physical oil market, portfolio, and the distribution outlook from here. Let's get into it. 172,000 jobs, against an 85,000 expectation, with 93,000 in upward revisions to March and April combined. The apparent paradox in a number like this is worth addressing directly. Strong employment looks like good news. In the current regime, it functions as the opposite for risk assets. Here's the mechanic. A resilient labour market means wage growth persists, demand holds, and the inflationary pressure the Fed's trying to suppress stays intact. Strong employment means the Fed can't cut without abandoning its inflation mandate, and a Fed that stays higher for longer means higher discount rates applied to future earnings, particularly for high-duration growth assets. The equity market doesn't sell a strong NFP because it's pessimistic about the economy. It sells because it's correctly pricing the rate path that number implies. Rate sensitivity, not sector quality, was the variable determining performance this week. The S&P 500 fell 2.84% to $7,383. The Nasdaq dropped 4.53% to $28,957. The Russell 2000 fell 3.66% to $2,816. The Dow held better at minus 0.32%. The Nasdaq leading the decline while the Dow outperformed is the duration story in pure form. High multiple growth names reprice fastest when yields spike because their valuations are most heavily dependent on the discount rate applied to future earnings. The Dow's energy, industrial, and financial weighting provides natural insulation in a rate shock week. Some of those sectors actively benefit from the same development that weighs on growth. The Russell underperformance follows from floating rate debt dynamics discussed across prior reports. A 3.57% rise in the 2-year is a direct headwind to small cap borrowing economics. The rate move itself is the catalyst. The VIX crossed 21.50, above the 20 risk regime threshold, for the first time since the early weeks of the Iran conflict. Bitcoin fell 17.5% to $60,693, briefly printing a wick low of $59,100. That $59,100 level matters. It's below the structural support that had held since February. If it confirms on weekly close, it constitutes a further bearish break in structure. The move itself isn't difficult to explain. Bitcoin's a liquidity conditional, zero yield, high beta asset. It's the first to feel liquidity compression in a rising rate environment and the last to recover when conditions ease. A 17.5% weekly move is the expected behaviour in a week like this one. The 4-year cycle context is worth sitting with. The April 2024 halving was followed by a bull run to approximately $126,200 in October 2025. Distribution. Bear phase now underway. Bitcoin's currently 51% below its all-time high. In prior cycles, peak to trough drawdowns ran to 77%, 84%, and 87% respectively. A 51% drawdown is, by historical comparison, consistent with the midpoint of a bear cycle, not its end. Every level on the way down has been called the bottom. At $110,000, a healthy correction. At $95,000, a normal pullback. At $80,000, the on-chain analytics community mobilized. Hash ribbons, MVRV ratios at historically attractive levels, long-term holder behavior consistent with prior bottoms. At $60,000, multiple signals are again described as a buy. The problem isn't that any individual signal is wrong, it's structural. Each signal is evaluated in relative isolation without adequately weighting the macro regime in which the asset's operating. Bitcoin's price isn't determined solely by on-chain mechanics or halving calendars. It's deeply sensitive to the global liquidity cycle, specifically to real interest rates and risk appetite. In a rising rate environment, with PCE at 3.77% and no credible path to near-term cuts, the underlying demand conditions are structurally challenged. No amount of on-chain signal analysis changes the macro regime in which the asset operates. The Valkyrie exit at $73,000 to $74,000 was signal-driven, just like the $107,000 exit before it. It's now sitting on the right side of a 17.5% weekly decline and the right side of a 40% plus decline since it sold near the top. Beneath the broad risk asset sell-off, one signal moved quietly and constructively. Oil, the Oman physical crude benchmark tracked here since report 22 as a deal probability indicator, fell 9.38% to $91.09. Brent rose marginally, 0.79% to $91.74. That creates a Brent premium of 65 cents. The paper barrel's trading back above the physical barrel. The spread history across this series is worth noting briefly. Report 22, Brent premium, deal optimism. Report 23, oil premium, deal pessimism. Report 24, near parity, maximum uncertainty. Report 25, oil premium, post-MOU hedging. Report 26, Brent premium returns. Physical crude buyers, like tanker operators, refiners, and logistics participants who actually take delivery through the Strait of Hormuz, are reducing the corridor risk premium they've been carrying mostly since conflict began. They're not calling a deal. They're saying the probability of one's improved enough to begin unwinding the freight discount. The physical market does its own probability discounting. It consistently has throughout this series. I heed the signal. No changes in Valkyrie this week. The model portfolio holds 38% US equity, 16% global developed ex-US, 6% emerging markets, 0% gold, 0% Bitcoin, 40% cash. The prior week's mechanical signal exits had already removed exposure to both gold and Bitcoin before their respective declines this week. Gold fell 4.83%, Bitcoin fell 17.5%. Neither required a decision this week because the decision had already been made by the system. The 40% cash position isn't a bearish forecast. It's the optionality value of preserved capital in an uncertain regime. That capital is available for signal-based redeployment when conditions shift. Patient capital in an uncertain regime's not an action. It's its own form of active risk management. The signal system will lead the re-entry. No discretionary override is contemplated. The distribution shifted modestly back toward the left this week. Bear case rises to 28%, up from 22%. Base case holds at 48%. Bull case falls to 24%, down from 30%. Distribution skew, alpha approximately negative 0.45. The NFP shock is the dominant input. 172,000 jobs against an 85,000 expectation removes the near-term rate cut case. VIX above 20 is the threshold event. The scenario in which the Fed holds to hike through sticky inflation and a resilient labour market's become more credible this week, not less. The partial offset is geopolitical. Oil below Brent's a constructive signal, and the Iran sub-distribution improves modestly, even as the macro distribution worsened. Two forces pulling in opposite directions, neither fully dominates. The next inflection points arrive close together. June 10th, US CPI, then June 16th, Warsh's first FOMC. Those two events will set the tone for the second half of 2026 more definitively than anything that happened this week. As always, the full report's linked below, and you can read or listen on Substack. If you appreciate these updates, please like, subscribe and share. It really helps get the content out there. Until next week, stay safe out there. Warsh.